In the last few days, I believe that we have gotten a signal, in my opinion, that most of or all of Kyle Bass's dollar shortage thesis on China is correct. I will explain my reasoning with articles. I'm going to do my best to keep this as easy to understand as possible if you're not financially sophisticated, because this involves derivatives. This involves a lot of China selling forward dollar swaps, an enormous amount of them. In fact, the amount of forward dollar swaps that China has sold is just absolutely enormous. There is an article from Seeking Alpha that Kyle Bass put out on his Twitter in the last couple months. It's from November 2nd, 2015, called China's Dollar Swap Addiction, that highlights this. So this has been snowballing and growing the size of China's derivatives position, basically trying to short the dollar and hoping that the dollar will become weaker. And unfortunately for emerging markets, unfortunately for China, the exact opposite has happened, because we have a trade-weighted dollar index today at all-time highs at 131.038, and the dollar index today is at 98.66, although for the purposes of China, the trade-weighted dollar, and the purposes of emerging markets and China, the trade-weighted dollar is probably more important. So, first, let me talk about a couple days ago. On September 2nd, we received news coverage that, surprisingly, and I'm shocked about this, that Zero Hedge has not covered. So Zero Hedge has not covered this. I don't know why. I don't know why anyone writing for someone sending articles to Zero Hedge has not covered this. But the Bank of Jinzhou, a couple days ago, Wall Street Journal reported on this, Reuters reported on this, that a Bank of Jinzhou said it would skip a year's worth of interest payments to international bondholders on its dollar bonds, days after reporting losses. Remember, the bank had not reported for over a year. So there were enormous problems. The bank reported a big increase, I think a six-fold increase in bad loans, and that's not the real number. And it's the first Chinese lender to protect its financial health by using this provision on its additional Tier 1 dollar bonds, analysts said, a form of, quote, contingent convertible or COCO bonds. The Wall Street Journal article, I'll put a link to it if you want to take a look. Now, this is important in my opinion, and this signals that China does not have the dollars, because if China does have the dollar reserves that it claims, it should have been very, very easy for the People's Bank of China, China's central bank, or even ICBC, which is one of China's two largest state-owned enterprise banks backed by the Chinese government. China owns a lot of banks, but there's particularly about 4 banks that are the largest in China, and ICBC is one. And if you remember, after the Baoshang Bank bailout in May, then the next one was Bank of Jinzhou in June, I believe, which was a Bear Stearns engineered government takeover where there was equity injections from ICBC Bank and 2 larger distressed debt firms. On top of that, then, the preceding bank, and these banks got larger with the more creativity in the bailouts. Then there was Hong Feng Bank, I think, in July, and that was the largest bank so far that has officially failed, and a subsidiary of one of China's sovereign investment funds had to take that over. Now, China spent a lot of time in May, June, and part of July. If you remember the stories that were coming out in Zero Hedge and elsewhere, it was very widely reported that there was big spikes in interbank lending in China. There was a credit freeze in interbank lending, which means the banks not only did not trust each other, they were charging each other more, and there was a demand for higher quality collateral and also larger quantities of collateral, which is not good for a very leveraged Chinese banking system. So China put in a lot of effort with emergency liquidity programs. They engineered at least 3 bailouts that we know of, okay? And why would they then all of a sudden just waste the time, the effort, the capital, the programs to allow this contagion, to allow this fear of banks stopping trusting each other to come again? And this is what has happened now in the last couple days, because after Bank of Jinzhou stopped making their dollar bond payments, if you look at the other bonds on the other regional Chinese banks, the Chinese bond market and the other holders of dollar bonds with China started to get spooked, and the value of those bonds took a shock and took a haircut. Okay? So that is very evident. They should have easily had the dollars to squash this, to prevent this risk of a spike in interbank lending charges and the banks worrying about interbank lending again. Okay, if they had the dollars, this would not be an issue. And ICBC Bank is one of the articles I just saw, I think it was translated into English. It said, and I'm not sure if anyone else will cover this, but I found an English translation, and there's a screenshot of the English translation article from an app called Proofreads in the Wall Street for Main Street Facebook group, talking about how ICBC wants to wait for a full audit of Bank of Jinzhou first before they decide what to do with the bank. The ICBC Bank does not own all the equity in Bank of Jinzhou, but they may have to do, my educated guess is they will have to do a lot more equity injections, cash infusions. And it is very interesting and also worrisome, I would say, why the Bank of Jinzhou was not helped out by the People's Bank of China or the ICBC Bank, which is one of the largest state-owned enterprise banks in China. Because, and I laid out exactly why, it would have been easy for them to put the dollars in unless they don't have the dollars. It would have been easy for them to put the dollars in, and this prevents the other dollar bonds and the other Chinese regional banks from basically repeating a lot of the same craziness that happened in May and June, that the Chinese People's Bank of China, the Chinese banking regulators, and the other larger Chinese banks worked so hard to try to calm down the fears. Calm down the interbank lending rate, the spike in interbank lending rates, and also calm down the bankers who are stopping trusting each other. This just reignites that fire. This reignites that worry. So that's why, in my opinion, that this does not make sense. Okay, so now that I've laid that out, let me talk about what Kyle Bass has been talking about now for the last couple months, and that is China's addiction to derivatives now, these dollar forward swaps. So there's this 2015, like I said, article from Seeking Alpha. It's very sophisticated, but to summarize it very succinctly, it's that China has been trying to short the dollar using derivatives, and they've been increasing the amount of derivative liabilities that they have using leverage. And the Chinese banks, so a lot of Chinese banks, and there's articles, I have articles about this. I'll read you the headlines. I've talked about these articles before. The articles are from, let me pull these up real quick. The articles are from Wednesday, August 7th, from the Business Times. China State Bank seen supporting yuan in forwards market sources. Now, people in the gold community on the alternative media say this doesn't matter. I'm telling you it matters, because these China state banks were ordered to do these derivatives trades. They were ordered, if you look at the chart, the exchange rate of the dollar-yuan exchange rate right around August 7th, which is when the story came out, China was attempting, the exchange rate had already broken 7. There was an attempt for a long time to try to keep the RMB below the psychological level of 7, squash it, knock it down, and then right around, let's see here, right around, it's beginning of August 5th, August 3rd, August 5th range, the RMB broke 7. There was an attempt to stop it until August 15th or so, and then it's taken off since. And my educated guess, is all those times where there was an attempt to try to stop the exchange rate, there were more and more derivatives layered on, these basically selling dollars, shorting dollars with derivatives, selling dollar forward swaps. And this brings a lot of potential long-term pain for China. And there's a very interesting article that Jeffrey P. Snyder from Alhambra Investments, if you're familiar with him, he's on Macro Voices all the time. He's the Eurodollar expert. He wrote on August 5th, 2019, a blog post called CN China 7, The Gears Behind the Clock Face. Now, a lot of the article I don't agree with, because he talks about how important it is for the euro. Everything around in Jeffrey's world centers around the euro dollar. That's really all that matters. But there's some really interesting tidbits in this article, including how other emerging markets attempted these derivative trades with forward swaps. So the Bank of International Settlements, if you go to the OTC derivatives outstanding, and you can go in there and they have it broken down, you can look up foreign exchange derivatives, the line item. And according to that, with currency swaps and also outright forwards and forex swaps, there's just massive trillions of these things. There's just enormous trillions. So for the US dollar alone, outright forwards and forex swaps, there's over 48 trillion of them. Total forex swaps with all the currencies, there's over 53 trillion of them. For regular currency swaps, there's over 21 trillion of them in US dollars. And for the total of all the currency swaps, there's over 24 trillion, almost 25 trillion. So there's trillions and trillions potentially. We don't know the exact number. I've never seen anyone mention the exact number of dollar forward swaps that China may have sold, but it appears through the articles and the evidence that this has been accelerating, that China's reserves started to dwindle long before Donald Trump won the 2016 presidential election, that the Chinese economy was having problems with dollar-denominated debt. Looks like before 2015, but things really started to take off, go crazy, haywire with derivatives, trying to short the dollar, betting on a weak dollar, trying to stabilize their currency in 2015, and it snowballed and gotten bigger and more leveraged and more dangerous for China since. And Jeffrey Snyder talks about this in his blog article. I'm going to quote him here. He says, Brazil's central bank in 2013 would write of another way of doing things. It wasn't anything new, but in the post-2011 world, the Brazilians saw a need to just pre-justify what they were about to do given what they saw were coming. It was as true then for Brazil as it was becoming for China. And so Brazil tried to sell a bunch of these forward dollar swaps, and Brazil's currency got hammered. Let me see here if I could find it mentioned in the article how much Brazil lost. I think their currency dropped over 50% in value in only a couple years. Brazil got absolutely hammered on this. So Brazil Central Bank was doing this at a much smaller scale than China has been doing, and Brazil got caught because the dollar did not get weaker. The dollar has rallied, and Brazil got absolutely hammered. Okay, let me see here. I read this article. I can't remember where exactly I saw the Brazil part here. And Jeffrey Snyder is saying that 2014, 2015, it just kept snowballing in this article for the People's Bank of China, that they were selling U.S. treasuries then, and then they went to the derivatives, so they didn't have to sell any more treasuries. And this would add to the dollar shortage thesis. Either China is out of dollars or they are very strictly rationing them. And Jeffrey Snyder's, his educated guess in this article is that now with the amount of derivatives that China has with these dollar forward swaps, that every 3 months, China has enormous amounts of pain with these derivatives because they're still shorting the dollar, trying to stabilize their own currency. I'm still skimming through the Brazil part. I can't find it. It's in here. It's a very long article. It's in here somewhere in the article. I can't remember. The Brazil currency dropped, I think, 60% over 60% in a couple years. And a lot of it was tied to derivatives. There was also a whistleblower from the Central Bank of Brazil who contacted Bloomberg and leaked some of this information to Bloomberg. This was a couple years ago. So the PBOC has been attempting with selling these forward dollar swaps. They've been loading up the leverage, loading up the derivatives, betting on a weak dollar, and it has not happened. And they've been attempting to stabilize the exchange rate. the dollar peg. Okay, so the contingent liabilities is a speech from a central banker, and a well-known advantage of issuing such contingent liabilities as currency swaps, which is what the dollar forward, selling forward dollar swaps, their variation of currency swaps, is that authorities become able to intervene in the exchange market indirectly without affecting the money supply or varying the stock of foreign exchange reserves. So beyond just the daily ban to peg the China's currency around the midpoint, to keep that midpoint nearly the same every day requires constant vigilance and direct activity. You might amass a war chest of off-balance sheet funds using contingent liabilities staggered out at 3-month intervals. That's Jeffrey Snyder's best guess. So that sounds like a pretty good guess to me, and that's probably why China's in my opinion, if they do have dollar reserves, they are rationing them. And the trade war with the U.S. and China's current account deficit, they're not running enormous trade surpluses with the U.S. to bring in those dollars. It's just exacerbating the problems because they have a lot of derivatives that they have to deliver the dollars to. And on top of that, they have all the dollar-denominated debt in their economy. They have the banks. They have the Chinese banks that had dollar-denominated debt. They have the Chinese real estate developers that had dollar-denominated debt. And they had the Chinese non-banking financial institutions and other private sector Chinese companies that borrowed in dollar-denominated debt too. So this is the problem for emerging markets and China, is the dollar-denominated debt. And then on top of this, China went and basically gambled with a bunch of derivatives, hoping and praying that they would get lucky that the dollar would devalue quickly and that they could pay off the derivatives with a stronger currency of their own and cheaper dollars. And the banks that were selling both onshore and offshore in China, that were selling these dollar forward swaps, they were ordered by the Chinese government. So the banks who were ordered to sell this, and in the articles here, it confirms that the journalist spoke to 4 sources at banks, from different banks in China, confirming that these happen. The gold community does not want to talk about this. The alternative media does not want to talk about this. They don't want to talk about how China has played these derivatives. And this is, if China would not have taken this dollar-denominated debt, if they would have not done these derivative games, if they would have not had this credit bubble and real estate bubble, they would be in much better shape now. According to Jeffrey Snyder, every 3 months to 6 months, so it's every 3 months, China's going to get even more pain now because of the amount of derivatives they have. I don't know if anyone knows, including Kyle Bass. I've never seen him talk about the exact number of dollar forward swaps that China has sold, but it's a massive number. It could be in the hundreds of billions. The trillions of dollars there say that they exist, so it could be in the trillions. Crazy stuff, right? So there was also another bank article that I forgot to read. Let me pull it up. This one's really interesting. Let's see here, where is it? This Reuters article came out on August 28th. It's called China's Big Banks Feel the Bailout Pinch. China's Big Four lenders are feeling the pressure of Beijing trying to slash a $310 billion pile of officially recognized bad debt, is pushing giants like China Construction Bank to help troubled smaller rivals or rescue them outright. First half earnings look healthy enough, but softer credit figures suggest they are already moving to shield their balance sheets. CCB, the country's second largest lender with 24 trillion yuan in assets, the largest one is ICBC, is a leader in efforts to rescue troubled state-owned borrowers through debt for equity swaps. In May, it was brought in to help the government's takeover of Baoshang Bank by handling its day-to-day business. That move was quickly followed by similar interventions at the Bank of Jinzhou and Hongfeng Bank involving other central institutions. There are almost certainly more to come. According to this article, the country's four heavyweights, CCB, Bank of China, Industrial and Commercial Bank of China, which is ICBC for short, and Agricultural Bank of China, hogged deposits and the best state clients. But they also lend to smaller institutions who provide credit to riskier private enterprises, a critical economic function. When the cost of borrowing for less sturdy banks relative to healthier peers blew out after Baoshang, the state giants appear to have simply increased short-term lending while regulators have made reassuring noises. Spreads narrowed again for the banks. But now the big boys, the big banks, have cause to worry. They'll be asked to do far more than issue short-term loans. The market still has little visibility into how much trouble some of these smaller regional Chinese banks are in, especially those with portfolios concentrated in struggling regions in Western China. Also, I would add dollar-denominated debt. The CCB did manage to increase earnings by a decent near 5% in the first half, but its net interest margins contracted, and it cut loans to other institutions in the interbank market. Here's an interesting thing here. What the second largest bank in China, guys, cut loans to other banking institutions in the interbank market by 25% from the end of December. So the amount of loans that the China Construction Bank, the second largest bank in China, cut to other banks in the interbank market dropped by 25% since December. Bank of Communications, the number 5 lender, reduced its exposure too, albeit by a smaller margin. Half-year figures also suggest smaller banks are having more difficulty raising funds from peers. The risk is a vicious cycle in which large lenders' caution creates stress at the lower end of the financial food chain, pushing more minnows into trouble. New yuan loans dipped nationally more than expected in July. There could be more pain ahead, according to this article. So the Reuters article is by Pete Sweeney from last week. These dollar forward swaps, a lot of people don't want to talk about them. You won't hear them mentioned in the gold community or the alternative media because it doesn't fit the narrative. But I'll just reread this article from August 7th. Now, first of all, if you want to get into the weeds, if you're more financially sophisticated and you want to read what a dollar forward swap is, there's the Investopedia article, What is a Forward Swap? I have that for the basics. So forward swap, often called a deferred swap, is an agreement between two parties to exchange assets on a fixed date in the future. Interest rate swaps are the most common type of a forward swap, though it could involve other financial instruments as well. And then there's more in-depth stuff there. But the more sophisticated articles are the China's dollar swap addiction from 2015, which goes into more detail about how China was starting to massively layer on derivatives to try to short the dollar and probably to hide that their reserves were dwindling so they didn't have to blow through any more of them, and to help stabilize their currency. And then also the Jeffrey Snyder blog post here. Although a lot of the euro dollar stuff I don't think the euro dollar is as big a deal as Jeffrey Snyder says. He believes that the euro dollar influences every single market on the planet, including the gold market, that it's the main influencer of that I totally disagree with. So the forward swaps are the derivatives. So here's the Reuters article from August 7th, 2019 by Winnie Zhao and Andrew Galbraith. China's main state-owned banks have been active in the yuan forwards markets this week, sources said, using swaps to curb greenback supply as authorities sought to slow the currency's decline after its break past the key 7 to the dollar threshold. The move to contain the yuan's decline comes after the Sino-US trade war broadened to include foreign exchange with Washington on Monday after branding Beijing a currency manipulator for the first time since 1994. That pushed the offshore yuan to a record low, and the onshore currency passed the psychologically important 7 to dollar mark for the first time in 11 years. 4 sources with knowledge of the matter told Reuters that state banks were seen swapping yuan for dollars, so selling dollars to try to shore up the yuan in onshore forwards market to support the Chinese unit. So they were dumping dollars to try to shore up their own currency. Quote, yesterday big banks were all selling 1-year onshore forward swaps. Then in the afternoon, the spot dollar yuan fell, said a trader at a foreign bank in Shanghai. While China's central bank had allowed the yuan on Monday to break through key levels, authorities are keen to avoid a precipitous decline that could trigger capital outflows and destabilize. So net capital outflows, there you go. That's why China has capital controls, and that's what emerging markets are always worried about, because the net capital outflows normally signal the crisis is about to get worse. Talked about this a couple hours ago. And I talked about this again a couple weeks ago. I predicted that emerging markets things would get worse. The sources said banks had conducted significant, and that the central banks would intervene and do a bunch of crazy stuff. The sources said banks had conducted significant amounts of buy-sell swaps in the onshore market on Tuesday. Buy-sell swaps help to reduce the supply of dollars that the market can access to short sell the yuan. So, excuse me, I stand corrected. They were trying to dump dollars. They were selling their they were trying to sell their dollars to stabilize the yuan. I think that's the right. Yeah, that's the right way of. They were trying to sell their dollars to stabilize their own yuan currency. But they can't do that permanently because you have to run trade surpluses. You have to have a lot of dollars to defend your currency. You can't do it unlimited, which is why China has resorted to so many derivatives. Analysts and market participants say major state-run banks often act on behalf of the People's Bank of China in the country's foreign exchange market. Quote, the central bank is guiding the yuan to depreciate in an orderly manner. I wouldn't call the depreciation in an orderly manner, but this expert is saying that the PBOC is trying to do that, and therefore chances for a one-off sharp devaluation are low. He expects the PBOC to continue to use tools including the daily midpoint fixing to lead the yuan's movements in the near future. One state bank also was seen active in offshore forward swaps. Another two traders at foreign banks with knowledge of the matter said. State banks have previously used such tactics to support the local currency. They were also seen selling forward dollars during the summer in 2018, pushing the one-year dollar-yuan swap points into negative territory, which implies an increase in the yuan's anticipated value against the dollar in a year's time. So they were trying to back then prop up the RMB, the value of the RMB back then in 2018. One of the sources said while one of the recent swap transactions were believed to be rollovers of last year's purchases, other orders over the past 2 days were new. Okay, I could go on and on about this. The rest of the article, you can read it. So China's playing in the derivatives market. They made even larger bets than Brazil did. Brazil was doing these forward dollar swaps too, and it blew up on Brazil, I think, in 2013 or 14. And Brazil's currency had a very big devaluation. Then I think it lost like 60% or something in a couple of years. And a lot of it was because of the derivatives. There was also a lot of dollar-denominated debt in Brazil too. And then Brazil, on top of that, they have a lot of commodity exports, and commodities have been in a bear market. Hey, thank you for the super chats, Toast Bill Clinton and Tarkinis. I like buying physical. This is not financial advice, but I like buying physical silver from like SD Bullion or Provident Metals. APMEX delivers quickly, but they tend to be higher in price. So, China, my point here is China would not need to do these derivatives. China would not have let this fire reignite, this worry reignite with Bank of Jinzhou not being able to pay their dollar bonds if they had the dollars. They should have the dollars. According to their statistics, they should have plenty of dollars to deal with the Bank of Jinzhou, and they should not have let this happen. So I think the Bank of Jinzhou signals that Kyle Bass is definitely on the right track. I don't know if China's totally out of dollars. I think it's probably more likely that China is very strictly rationing the dollars they have left, and they're saving it for larger bank bailouts or to buy oil if the oil price crashes, or to buy food and agriculture, gold, metal. China needs dollars still to import those commodities. They also need the dollars to help with dollar-denominated debt. So there's a number of important things that China needs dollars for. And it's very interesting that they worked so hard to try to calm down the interbank lending markets and the credit freeze up and the spike in interbank lending, the interest rates charged for interbank lending. And then here we are, they let it go again. In a couple days ago. Very interesting, right? So if you guys want to go more in depth on this, I have the articles. I will put them in the information and description section of the video. Thank you very much to my almost 150 Patreon account contributors and my almost half a dozen monthly PayPal contributors. You guys are really helping me out here. We have a couple... I'll take a look for the last couple minutes here. I'm not going to be here that much longer because I've already done another live stream show today. Tomcat says gold will not feed China. This is correct. Gold will not totally save China. If China is, we don't know the number of dollar forward swaps that they're selling, but guys, if the amount of dollar forward swaps that China's selling is in the trillions, they're in trouble. In very big trouble. If they would not have done this, they would have been in a lot better shape. The dollar denominated debt plus the dollar forward swap derivatives, they would be in much better shape. But on top of this, they have a credit bubble. They have a real estate bubble. Now, China can deal with the RMB debt way, way easier. However, it is a totally different scenario for China to deal with dollar-denominated debt and with these dollar derivatives. If China got desperate enough, they could potentially sell some gold, but I think they would rather not. So I think that would be their last option. So I think Kyle Bass is definitely on the right track, and I think there's what happened a couple days ago only increases the odds that he's correct. Because if China had no dollar shortage, as China bulls claim, as people in China claim, that should not have been an issue. Because all the progress that was made to calm the Chinese banking system down, especially the regional Chinese banks, to calm that down in May, June, July, that has started to rile up again. It just does not make sense unless they don't have the dollars. Either they're very strictly rationing them and Bank of Jinzhou is not a priority, so they're not getting the dollars, or the liabilities that Bank of Jinzhou has with this full audit. Once ICBC is done with the full audit, they're going to find out, oh my God, the derivatives and liabilities that the Bank of Jinzhou has are way larger than anyone thought. That could be another possibility. Yeah, Cole says that food will be China's Achilles heel. I think food is the most important. If higher food prices continue to accelerate, that will really, really hurt stability in China. That could lead to very increasing amounts of political unrest in the mainland. So I don't agree with everything Kyle Bass says all the time. He has made some bets that have not worked out against governments. Although he is a billionaire, he's a very successful guy. I respect him a lot. But it appears that he is on the right track here. And this news story from a couple days ago, I think it adds a lot of credibility. I do not know why Zero Hedge does not want to cover this. This is very weird. I think this is big. Okay, guys, well, that's it for now. I'm going to go take a break, and I'll put all these article links in the information and description section. If you guys want to go more in depth on this, if you're sophisticated and want to learn about these derivatives, there's the articles I'll talk about that explain this in more detail. But when you put all the pieces to the puzzle together, it looks like China has been playing with hundreds of billions, if not trillions, in these forward dollar swaps. Just an insane amount of dumb bets to short the dollar. And as we know, by looking at the dollar index and the trade-weighted dollar, the bets have gone against them. Okay, bye for now.